This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com. Founded by Jim Cramer, TheStreet.com is an independent source for stock market analysis. Cramer's Action Alerts Plus service is home to his multi-million-dollar portfolio. You can learn more at TheStreet.com/NBR.
Bruised Apple. Fewer iPhones sold and revenue won't be as strong as expected. So what should investors do with shares of one of the world's most valuable companies?
Global hotspots with the emerging markets in focus. Which countries in crisis could have the biggest impact on your money?
And now it's the Fed's turn. Central bank policymakers meet this week. Will they or won't they continue to cut back on stimulus, especially with the recent turmoil in the markets? We have all that and more tonight on Nightly Business Report for Monday, January 27th.
Good evening, everyone, and welcome. A rough day for stocks got a little rougher after the market closed. That's because Apple reported its quarterly earnings. The revenue and profit numbers were fine. They beat Wall Street estimates, in fact. But sales of iPhones at 51 million units fell far short of forecasts, and Apple's own revenue predictions for the current quarter disappointed investors. And they initially sold the stock hard in after-hours trading. Seema Modi joins us now from the NASDAQ with some insight into Apple's results. Seema, what are the big takeaways you see in the numbers tonight?
Tyler, it's those disappointing iPhone sales. That seems to be what's worrying the street. Apple sold 51 million iPhones in the first quarter, whereas Wall Street was expecting around 54 million phones to have been sold. Gartner analysts telling me that means Apple is dealing with saturation at the high end of the smartphone market. Now, the amount of iPads sold in the first quarter also fell short of street consensus. So while the overall earnings and revenue numbers beat estimates, it's the iPhone and iPad sales that seems to be worrying the street. That's why we're looking at shares down after hours. Tyler?
All right, Seema Modi, thank you very much. Well, it was an up and down session on Wall Street today, but mostly down. Despite some brief flurries, and I'm not talking snow, the major averages all extended last week's losses. Investors were chilled by a 7% decline in new home sales and lingering worries about China's economy and the currencies and economies of several emerging market countries. Oh, and there's also that Fed meeting that begins tomorrow. Taper talk didn't cheer the markets very much today either. The Dow down 41 points. The NASDAQ was off 44. With the tech sector weighing on the index, the S&P lost 8.
The biggest gainer in today's losing session for the Dow was Caterpillar. The giant equipment maker reported earnings and revenues that topped analyst estimates. Shares surged nearly 6% on that news. Morgan Brennan has more on what drove Cat's strong quarter and why investors are buying in.
With profit up almost 50% from a year ago, Caterpillar, the world's largest maker of mining and construction equipment, blew past analysts' expectations. Some are saying the better-than-expected numbers represent a watershed event for a company that's struggled in recent years.
Mining is weak and remains weak, but the other two parts, power systems, construction, will more than offset it. And even with some headwinds, you're going to have a better year in 2014. This really changes the outlook for Caterpillar to a much more positive scenario for the next couple of years.
Because Cat's heavy machinery supplies a variety of industrial needs across the globe, it's considered a good early indicator for the global economy. Cat's good numbers are particularly encouraging after the drop in demand since 2012, taking the stock down about 6% over the past year and more than 20% over the past 2. Demand for Caterpillar products may be coming back, especially in North America, where construction is beginning to rebound. But the earnings also reflect aggressive cost-cutting measures. Caterpillar has cut almost 10,000 jobs in the past year and slashed inventory levels. The company's profits also shine a spotlight on China, where recent data is fueling worries about the health of the world's second-largest economy. Even so, Caterpillar says sales and revenues in China grew 20% last year, and analysts note that its exposure to the country remains relatively small.
China is a pretty small portion of the overall Caterpillar business. It obviously affects their mining business quite a bit. If we can just get some stability in emerging markets, I think that's where you could see the stock really perform pretty well.
But these headwinds may not keep the stock down for long. Shares of Caterpillar hit their highest level since late 2011 during today's trading. And with the company planning to buy back another $10 billion worth of stock, a number of analysts continue to rate it a buy. For Nightly Business Report, I'm Morgan Brennan.
Coming up, remember 1997? Well, many investors do, and now they're wondering if this is the start of a similar currency crisis and what it might mean for your money.
Two big events this week that are worrying investors here in the U.S. and all over the globe. The sell-off in currencies in emerging markets and the Federal Reserve's two-day policy meeting. Michelle Caruso-Cabrera has more on the global currency hotspots and why they matter to American investors.
The most troubled emerging markets this week weren't necessarily the biggest or most important economies, at least not yet. Turkey and Argentina are the cornerstone of the recent massive sell-offs, especially when it comes to their currencies. It started with political troubles, which has made investing in those countries far more risky, and that's led investors to abandon their investments. When you leave a country as an investor, you sell its currency because you don't need it anymore. We've seen the selling occur, though, also in other parts of Latin America, including Brazil and Mexico, plus parts of Southeast Asia, such as Indonesia and India, and you can add South Africa to the mix as well. All of these countries have their particular issues, but here's what's true of all of them. When interest rates were extremely low in the United States, investors were willing to go to riskier places in the world in order to get paid higher interest rates. But as the U.S. economy improves and the Fed begins to take its foot off the gas pedal, U.S. interest rates are expected to rise. That makes those other countries less attractive unless they raise their interest rates too. Problem is, that also slows down their economy. The Turkish Central Bank is holding an emergency meeting tomorrow where they are expected to hike rates between 2% and 4%. Those are extreme moves to Americans who are used to the Fed moving only 0.25% at a time. But desperate times call for desperate measures. For Nightly Business Report, Michelle Caruso-Cabrera.
More now on the other big concern for the markets this week. That would be the Fed's meeting kicking off tomorrow. Steve Leisman has more on how the central bank's decisions on its asset-buying stimulus plans and interest rates could further roil world markets.
Broad expectations on Wall Street that neither emerging market problems nor currency volatility nor a weak December employment report will stay the Federal Reserve from its appointed rounds of completing QE3 this year. It's expected to continue the process that it began in December with another cut to bond purchases at its January meeting, which ends on Wednesday. This is, of course, Fed Chairman Bernanke's last meeting after 8 years in the leadership seat. Janet Yellen takes over as chair on February 1st, and her first meeting will be in March when there will be a press conference. But for now, here's how market observers think the Fed is likely considering recent market volatility. Does it change the forecast? Answer, probably not. Does it represent systemic risk to the U.S. and global systems? Again, the answer is probably not. And are there underlying macroeconomic troubles that link all of the countries? Again, the answer appears to be no. Officials who I spoke with see the events of the past several days as more linked to specific events in specific countries, more political than economic.
Several of them have very key elections, and most of these elections have a high level of uncertainty attached to them. India is having elections, Turkey's having elections, Brazil's having elections, for just to name a few, and these are all very complicated.
But there's also a link to Fed policy. A lot of money has flooded into emerging markets seeking higher rates of return on those countries' bonds. Now that the Fed is reducing its efforts to keep rates low here in the U.S. and interest rates have risen a bit, some of that money is fleeing emerging markets and coming back home. But there's another reason. The outlook for growth has also changed, with less growth expected in the emerging countries and more in developed countries like the U.S. and Europe. So money is following the growth. For Nightly Business Report, I'm Steve Leisman.
The currency sell-offs in the emerging markets bring back bad memories of the 1997 Asian crisis. Back then, there were fears of a worldwide economic meltdown. But as Sarah Eisen reports, this time, things are different.
Plunging currencies from Argentina to Turkey to Ukraine are triggering bad memories on Wall Street. It all goes back to 1997, when a sharp drop in Thailand's currency, the baht, set off a chain reaction in other markets, nailing economies in Malaysia, Indonesia, and the Philippines. It sent shockwaves around the world and multiple bailouts from the IMF and even the United States. Investors are wondering, could Argentina or Turkey become the next Thailand? But some on Wall Street say this time is different.
This isn't a crisis level. This is a couple-day sell-off. I'm not sure that it's going to be sustained to affect policy or to affect economic outcomes.
So what's changed? China is a bigger economic powerhouse. Now the world's second biggest economy, its share of the world economy is 4 times what it was in 1997. That means China could act as an anchor of stability if developing markets shake, or cause a lot more trouble if it shows signs of weakness.
There's a lot of capital that's actually come back into China, and that's the point of maximum vulnerability.
Another difference now? The Federal Reserve is in the middle of a balancing act, tapering or scaling back its stimulus it put in place to help fight the financial crisis without disrupting the economy and the markets. The worry for U.S. investors? The world economies are now much more intertwined, and an emerging market meltdown could hit U.S. markets and companies, particularly multinationals, that had depended on faster-growing developing nations for growth.
The big worry is that the EM currencies and the EM countries' share of GDP is much larger than it was back in 1997, 1998. So you had developing countries roughly about 20% of GDP, and then it's now about 40% of GDP. So the ripple effects can be much larger.
And while analysts say brace for more financial swings and turbulence ahead, it doesn't appear to be a full-blown crisis a la 1997 yet. The key will be reaction to the Federal Reserve announcement Wednesday and any news on the health of China's economy. For Nightly Business Report, I'm Sarah Eisen.
Well, here to discuss everything under the sun, from currency turmoil to the Fed to the fate of emerging market economies, maybe even the Super Bowl, is Chris Heisey, Chief Investment Officer for U.S. Trust. Chris, welcome. Good to have you with us.
How you doing, Tyler?
Let's start where Sarah Eisen left off, and that is with the currency turmoil currently rattling everywhere from Thailand to Argentina to Turkey to South Africa. Is this possibly going to become a kind of contagion that could do really sustained damage to developed markets, or not?
Well, you know, when you take a look at the picture that's going on now versus the mid to late 1990s, as you've referenced, virtually every emerging market had a currency crisis from 1994, starting in Mexico and going all the way to the Russian ruble in 1998, and then again with Argentina and Brazil in the early 2000s. You would say it's back to the future all over again, but the key main difference is, number one, the United States is on very firm footing right now and getting better from a growth outlook perspective. Obviously, from a monetary policy perspective, there's the Fed tapering concerns of pulling liquidity away from particularly those countries that need it. That's still going to be there. But from a financial contagion perspective, putting what's going on today, making it very similar to back then, complete polar opposites as far as we're concerned. And the other big difference is $17 trillion in cash around the world, Tyler, that's out there, that's very liquid, that's still trying to find a home to invest in for the next few years.
You know, Chris, on Friday, after the markets closed, people were really freaked out going into this weekend. I mean, there's the Dow down over 300 points, and all of this talk about crisis. What changed that today it was just like a normal, you know, middle of the road kind of sell off on Wall Street?
You know, part of it is the fact that the selling pressure just didn't pull through as much as everyone expected. They tried it around midday when the Dow and the S&P were down, you know, a little around 1% or so. But everyone's pointing to the fact that we haven't had a big correction in the last 12 months. We had a 6 to 7% correction somewhere around the May-June when tapering talk was the first initial shot. Emerging markets never really came back except for that one cyclical episode in the fall. But the reason why it's not pulling through right now is because the outlook for 2014 is a much better growth outlook than last year. Europe is going to grow at 1% versus -1. Japan's probably going to repeat their performance, and the U.S. will grow closer to 3.5 versus 2. So the outlook economically and profits, even in fair valued markets, is a lot better this year than last year.
Let's talk about the Fed a little bit. Since they last met, some of the economic data have not been exactly rosy. A poor jobs number today, some housing numbers that were a little bit soggy. Do you think that that will change in any way their proclivity to taper or pull back on stimulus?
Yeah, it really doesn't look that way, Tyler. The only thing that's really going to change their so-called measured tapering under the Yellen Fed is that this particular noise in the system around the emerging markets becomes a contagion. We think that's an extremely low probability event. It's out there. but it's a low probability event. The jobs numbers going back to December, there's a lot of noise in the system in any 1 month jobs number. When you go back and look at the 3-month trends, they're very robust. And yes, they're not as strong as prior cycles, but I would argue that there's a lot of reasons for that. A lot of it's demographics. The one thing that I think a lot of investment participants are getting wrong is they're looking at the participation rate and they're assuming that people are leaving the job force because they're discouraged. Actually, the growth in jobs is heavier than the growth in the participation rate, so the unemployment rate goes down. That's actually a pretty good thing, and that's why we should see a lower unemployment rate than the Fed even expects by mid-year.
Chris, thank you very much for your insight tonight.
You bet.
Chris Heisey, Chief Investment Officer for U.S. Trust.
Well, economists are not only worried about slowing growth in China, but also the rise of what's called a shadow banking system there. From Beijing, Eunice Yoon explains what that is and the risks involved.
Zhou Zhang is a shadow banker. He runs a microcredit firm in southern China. A former investment banker, he now funds small-time clients, anyone from fruit growers and street hawkers to mom-and-pop shops.
We are a very important supplement to the traditional banking system. Small and medium-sized companies and underprivileged consumers have no way to access a bank credit, but they can come to us.
China's financial sector has long been controlled by the government. The big state-run banks funnel funds to other state-owned enterprises or industries and projects targeted by government economic policy.
State-owned enterprises easily get funding for big projects like this one.
That means some companies can cash in whenever they want, while others, usually private companies, are largely cut off, fostering an alternative shadow financial sector. Zhang charges borrowers 24% a year on loans that need to be paid back in 3 to 9 months.
That's really scapegoating people like us. We are doing a legitimate business.
But not everybody in shadow banking is. The $6 trillion industry encompasses all sorts of untraditional financing, everything from micro-lenders to indirect or off-balance sheet loans from banks. Recently, some of those investments have gone sour, raising fears of defaults in an unregulated sector that could endanger the nation's banks and ripple throughout the financial world. Zhang says his clients are riskier, but he argues shadow bankers like him do more rigorous credit analysis than the government-backed banks.
We have skin in the game, so to speak. We're very careful with the management of our money. If our loans go bad, it hurts our own pocket.
Yet if too many loans go bad, many believe it will hurt China and the world. For Nightly Business Report, I'm Eunice Yoon.
Coming up, why two Dow components, both big drug makers, are having very different days.
Some big tech firms have reached a deal with the Justice Department over the NSA's spying on Americans. The agreement settles how much tech and telecom companies will now be allowed to disclose to the public about the NSA's phone and internet record keeping on U.S. citizens.
Back now to our top story, Apple. Our guest tonight owns shares of the company and says he's adding more to his portfolio. He's John Stevenson, portfolio manager at First Asset Investment Management. John, thanks for joining us. You know, everybody this afternoon was talking about what's wrong with Apple, and its stock was selling off, and you're adding to your portfolios. What does Apple have going for it?
Pretty much everything. The stock is cheap. That's the first thing. It's trading at 9 times X cash versus the overall market at 15 times, and the tech sector at 13.6. And then even if you throw in the implications of cash, you're at 12.7 times or so. So it's still cheap. It's got early days really with China, Brazil, India. So emerging markets are still a growth story. It hasn't done anything in enterprise. Plus it has a ton of potential. I mean, it's got 575 million customers that they can tap into new services, internet-based services, or just additional offerings. So that's something that, and then of course there's the widely rumored iWatch, iTV, maybe a combined iPad / MacBook Air. So there's tons of potential that the company has. And again, it's a company that is very inexpensive. So I think it really has everything going for it.
John, the company had record revenues in the quarter. It beat estimates on the top and bottom lines. And yet, investors seem to focus on two things: iPhone sales, which didn't quite measure up to the forecasts, and the outlook for the current quarter's revenues. Are they getting it wrong?
Well, I think there is some concern. I mean, first quarter is seasonally weak. Of course, you have this last quarter very, very strong because of the holiday season. I think it really what came down to guidance. iPhone sales were a little bit light at 51 million. Versus the street expectation at 56. But when you look at what happened, is earnings were quite substantial. They really beat quite handily, 1450 versus the street at 1409. And I think the deal was that the iPhone 5S, which is high margin, really carried the day. So I think the good news is they're selling more of the high margin stuff. And again, all of China Mobile is huge. And I think you've got a potential to have, 10 billion or more in additional revenue through the course of the next 12 months, because this is just a new deal. So I think overall, it looks very attractive going forward, but again, the guidance for that first quarter was a little bit weak, and people were disappointed. I mean, it came in quite a bit lower than people were hoping.
Right. I hear what you're saying, John, but I just wonder, do you think that Apple management, Tim Cook, is going to feel pressured that he has to do something to, stem this sell-off in the stock, maybe raise the dividend, maybe, buy back shares, the kinds of things that Carl Icahn, the activist investor, has been calling for?
Yeah, no, I think there's going to be some of that, but I don't think you're going to see $142 a share coming back to investors anytime soon. I mean, I think you're looking at some potential for share buybacks, some potential for a dividend increase. I think that's clearly where they need to go over time. But I think what they should be doing is really innovating for that next wave, because I think that's really what the street is looking for. What is going to take it higher? Will it be the iPhone 6, potentially with a bigger screen? That will allow them to go more head-to-head with Samsung's offering. But I think that's where the focus will remain and should remain.
That's one of the things that I've been curious about, whether they're going to come out with a larger screen phone, because my guess is that what I seem to hear you suggesting, John, is that they need to get their wow back. They haven't had the wow in the last year or two.
Yeah, I don't know if you're like me, Tyler, but I mean, I pretty much have every Apple product out there. And, it's pretty exciting at first when you get it. But then you think, well, you know what, I kind of know my way around the 5 and the 5S. And I don't see a huge implication for it. But I do think that what they've done is they've put together a lot of really good pieces. I do think the large screen iPhone that's rumored to come out with a 5-inch screen will be a big game changer for them. I do think they're early days in the enterprise market. And keep in mind the biometrics that they came out with the 5S, that will help them in terms of security going forward. And they have a fully integrated program where they have both the software and the hardware. And, that allows them a tremendous user experience. When you buy an Android phone, which is, and the phones are really the bread and butter of this company, you're stuck with the operating system. But within a month, 70% of the people have a new operating system when iOS is updated.
All right, John, thanks a lot for all that information. Really appreciate it. John Stevenson, portfolio manager at First Asset Investment Management.
Well, Comcast and Charter Communications are reportedly nearing a deal to buy Time Warner Cable assets, and that is where we begin tonight's market focus. Charter has agreed in principle to sell some of Time Warner Cable's assets to Comcast, but only if it succeeds in buying the remaining parts of Time Warner Cable for itself. The deal to sell off some assets would give Charter additional funds to complete the takeover of the cable company. Shares of Comcast up slightly, $52.49. The close there. Shares of Charter surged 4% to $136.92. Time Warner Cable fell a little, $133.45. Pfizer's experimental lung cancer drug failed to meet its goals in 2 late-stage trials. Patients giving the drug did not show improved survival without the disease progressing. The results disappointed investors, and shares fell nearly 1.5% to $29.66. Shares of Merck, by contrast, hit a record high after Morgan Stanley upgraded the stock to overweight from underweight. The analyst there said the company's prospects for a new cancer drug have improved and could bring more than $6 billion in annual sales to the company by the year 2020. The drug maker's stock up 1% to $52.53.
Well, it was just the opposite at Cisco Systems. Its rating was downgraded by J.P. Morgan Chase from neutral to underweight. The firm cited Cisco's high valuation as well as weakness in the emerging markets. Shares slipped a fraction to $22 a share. AT&T told British regulators it won't be making a near-term bid for European telecom giant Vodafone. Now that AT&T has denied a takeover bid, it must wait 6 months if it decides to make a buyout offer for the company. That's according to UK takeover rules. Shares of AT&T rose slightly to $33.51. And Royal Caribbean posted an earnings beat thanks to improved ticket sales. The cruise operator also gave investors a rosier full-year outlook despite a recent illness outbreak that affected 600 passengers on one of its ships recently. The company's CEO doesn't think the outbreak will deter customers.
I don't think it has a big impact on bookings because most people understand just how common this thing is. It's the second most common illness in America. Of course, you up in the north are having bad weather, and in the winter, this kind of thing does occur. And fortunately, an outbreak is defined as only 3% of the people, and it's still a very rare occurrence.
And shares were up nearly 2% to $48.04. And that's Nightly Business Report for tonight. I'm Susie Garib. Thanks for joining us.
And thanks from me as well. I'm Tyler Matheson. Have a great evening, everybody. We'll see you back here tomorrow night.
Nightly Business Report has been brought to you in part by
TheStreet.com. Founded by Jim Cramer, TheStreet.com is an independent source for stock market analysis. Cramer's Action Alerts Plus service is home to his multi-million-dollar portfolio. You can learn more at TheStreet.com/NBR.
I'm Susie Garib with a Nightly Business Report news brief. A rough day for stocks on Wall Street got a little rougher after the market closed. That's because Apple reported quarterly earnings. iPhone sales were weak, and the outlook for the next 3 months disappointed investors. Also today, investors worried about a 7% decline in new home sales and lingering concerns about the currencies and economies of several emerging market countries. The Dow was down 41 points, despite shares of Caterpillar soaring 6% on strong earnings. The Nasdaq lost 44, with the tech sector weighing on the index, and the S&P was off 8 points. And it's going to cost you more to mail those letters and bills. The price of a first-class stamp rose 3 cents to 49 cents. Be sure to tune into Nightly Business Report right here on your public television station.